TheoTrade. This is Don Kaufman. It's January 2nd, 2019. It's the first trading day of 2019, and you are watching the TheoTrade evening video. You know, if there's one word to describe this marketplace today, instability. We're just all over the place in today's trading session. You know, if you kind of tuned in here, it's about 10 minutes left in the trading session. If you tuned in right at the end of the day, you're thinking to yourself, right, nothing really occurred. Not much happened. And then you take a look at the high and low inside of the S&Ps specifically. Overnight, we traded 24.52 to a high of 25.21. You're looking at a 70-point range in a marketplace that is going to end today's session largely unchanged. Now, why do I kind of, throw out there instability? Not specifically because of the range. Let me actually dig a little bit deeper than that. I think that the range itself was a little shocking to kick off the trading day of the year. And again, it's following a holiday, and we're doing 1.7 million contracts in the S&P futures. I mean, people, come on, we're getting it done, meaning that that volume, it's absolutely there. It's kind of like the holiday season never existed. Everybody, they showed up, and they showed up to trade today. Let me show you again details of why I talk about instability. The first thing that really stood out to me today isn't so much the S&Ps in the large range. It was a lot of what we kind of look at as old school Dow-based theory coming back into play. If you guys have never heard about the dogs of the Dow theory, well, let me bring you to Goldman Sachs. Why Goldman Sachs? Because Goldman Sachs in 2018, it was the dog. What effectively does the dog mean? There's 30 stocks inside of the Dow. Goldman Sachs was the absolute underperformer inside of the Dow. It actually finished the year down just about 34%. Okay, it's popping up in a fairly large way today. It's one of the top performers out there. Now, on the flip side of that, so Goldman Sachs is up and up big. You're like, all right, so maybe they're buying Goldman Sachs because it was so beaten up. But then you look at the other side of the spectrum. The absolute top performer in the Dow was none other than Merck, which is actually going to finish down, okay, about 1.25%. Just want to throw this out there for your consumption. First of all, to see Merck as being the top performer in the Dow, 2018 at that point was a fairly wild year. Okay, what came in second in the Dow? Pfizer. And third, the third best performer inside of the Dow was none other than Microsoft, which again is down. So there's this, again, kind of like Dow theory playing out, at least in this first trading session of the year, where they're buying the dogs, okay, and selling some of the top performers. But again, that just kind of reeks of like, old school money management. How does that equate to instability? Well, let me get down and dirty here into some details of why I said this marketplace just, again, reeks of instability. Let's cruise over to the financials. So the financials, okay, as we just showed, Goldman Sachs is up over 2%, but the financials themselves are up about 0.5%. Oh, okay, who cares? Not a huge move, especially since, the financials have been really beaten down recently, getting a bid back under them, being up 0.5%. You normally, again, you wouldn't care, except for the fact that the bonds are just taking off to the upside. The bonds are up, okay, a full point. By the way, 31 ticks is 1 tick shy of a full point move. Now, people, come on, we've seen a lot of volatility recently. And in the midst of the volatility that we've seen, the bonds have rallied and continued to kind of rally when the marketplace was selling off. Except today, you've got the bonds rallying. It's not selling the market down. It's not influencing the financials in any way, shape, or form. Again, typically what you see is when the bonds are being bought, what does that do to the yield? Okay, the interest rate associated with this goes down. Lower interest rates often hurt the financials. Today, just thrown out the window. okay? I don't trust this marketplace as far as you can throw it. And I'm also going to throw this out to you, okay? The volume inside of those bonds today, it too is getting it done. People showed up and they're trading today. Now, to kind of further that, if you take a look at the notes, which is a 10-year, only moved about 8 ticks. Again, doing lots of volume and also rallying back to the upside. There is and again, if you don't necessarily look at the bonds and the notes on a day-to-day basis, don't let that get you down, okay? Bonds rallying is indicative, typically and recently, of the financial selling. Notes rallying, again, is indicative of the financials kind of selling off. Today, say it ain't so. At the same time, okay, we've also seen, when I talk about this idea of like instability, I think you have to go look at oil. And you have to look at oil on an intraday basis. Now, this might not look, okay, like much. And of course, people would point out there's going to be news. Please, news would have spiked oil, okay, in one clean movement. And yes, there's been news breaking on oil, okay. The trades that were coming out in oil, though, this just looked like attack of the algorithms. Now, it's not often that I come on to a TheoTrade evening video and talk extensively about intraday trade. But here's a trading session, again, that we're going to finish largely mixed for the first trading session of the year. The volatility is down, okay? But in some context, it looks like, our risk assets like bonds, they've rallied up, okay? Are we towards, possibly the top of this range of a rally, okay? Quite possibly. The bonds, though, are they rallying to be defensive? That's the question that we need to answer for the remainder of this week. Now, if you think like, maybe volatility just died down, let me also bring you into one last thought over here. Again, I know that when you tune into this video, you're searching for direction, you're searching for bias, and I'm going to give you everything but that. Let me kind of leave you with this thought. Now, earlier, and I'm going to zoom very, very tightly into this, earlier this week, the S&Ps, okay, were slated for an $84 expected move. That's $84 up, okay, or $84 down. Now, where are we currently? I mean, we're just off of the starting place of the week, okay? And this week, of course, included what? So here's Monday, okay? This happens to be Wednesday. We have nothing left but Thursday and Friday. Now, we were slated again for an $84 expected move. We're expecting Mr. Toad's wild ride inside of the marketplace, and we've gotten absolutely nothing, okay? I suspect Thursday and Friday of this week is going to be met again with much more extreme movement, and it's what we need right now. Again, if we burst to the upside, we're actually going to step in and short when and where possible. Most likely, we're going to have to get short around major index products. Why? Because most of your equity products are now getting very close to earnings. And we don't want to sell premium and have to hold through the earnings because the options are not going to decay very effectively. So if we rally up, we're going to be selling, okay, out of the money calls and call spreads. If we start to come on back down, we're actually going to wait for some very serious sell-side activity and once again look to allocate into some iron condors. But as I said, I suggest, okay, that we're very likely to make a vast move higher or lower. Again, that information is predicated specifically on this expected move. And I'll further that with, all right, so there's this $84 expected move, okay? Why should we believe that a large move is coming? Since the volatility kicked off right here, let's come all the way back to October. Let's back up my statement with a little bit of homework. These are the weekly expected moves, okay? Beginning of October, we touched the edge of the expected move. Here, we breached the edge of the expected move, okay? Then we have a week. Look at this. We actually had a week. We did nothing, okay? After that, we breached the edge of the expected move. Here, we touched the edge of the expected move. We touched the edge of the expected move. We breached to the downside. Here's another one. We breached to the downside. We breached it then to the upside. We breached the expected move to the downside. Here's one more week. We didn't do very much of anything. We breached to the downside. Okay, here we actually touched the upside of the expected move. There's the closing bell. And again, this final week, this one is the question mark at this point in time. Again, we suspect some heavy volatility is in store for us again this Thursday or Friday. It does appear that the bonds have moved into a highly defensive position. They're rallying. Almost feel like we're trying to draw out traders, get everybody to bite on the idea that the S&Ps are going to continue to rally. Once everybody bites on that idea that the S&Ps are going to rally, they're going to head for another round of some fairly tumultuous downside activity. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.